We will be recording today's session, but first let me introduce today's presenters. First, Mr. Sunil Swamy. Sunil is Alerus's Chief Investment Officer. Mr. Josh Richter. Josh manages the fixed income portfolio here at Alerus. And Mr. Deepak Chalagai. Deepak is a Senior Equity Analyst here at our firm. We're very pleased to have you. And before we get started and I turn it over to Sunil, a couple of housekeeping items. All of you are joining today's Webex on mute. This will help keep the audio quality for everyone. We have completed sound checks, but if at any point during today's presentation the quality appears to disappear or you're having issues, simply enter information into the Q&A and we'll try to troubleshoot with you. Today's session will be recorded and available at alerus.com/making sense of the market. And then just a couple of Webex tips for those that may not be as familiar. On the top right of your screen, you are able to see an icon that allows you to change the display so that you're able to better view today's presentation. And then you'll notice on the very bottom, if you click those three little dots, you can expand the Q&A section. Our goal today is to try to make this as interactive as possible. And in order to do that, we ask that you submit your questions after the formal comments are delivered from the investment team today, which we anticipate will be around 45 minutes. We'll be sure to save the last 10 or 15 minutes for any questions that you might have. Feel free to enter those questions at any point throughout today's presentation. You'll also notice that there is a chat feature. We would ask that you use the Q&A functionality to submit questions. We'll monitor that closely throughout the presentation today. And finally, at the close of today's webinar, you will be asked for feedback. We encourage you to provide that feedback so that we can continue to improve future webinars. Without further ado, I will turn it over to our Chief Investment Officer, Sunil Swamy. Sunil, the floor is yours.
Thank you, Brian, and thank you all for joining us. Welcome. Last year, we did a couple of webinars in the midst of the pandemic. We got some favorable responses. So we thought we should probably continue that series and make it a quarterly event. What we'd like to do today is very quickly review what happened in 2020, particularly in the financial markets, then provide you with our outlook for 2021. We actually have a very constructive outlook on the US economy for this year. And that's due to three very important major factors. One, we expect the vaccine rollout that began last month to continue through the rest of the year and lead to reopening of the US economy. We already have 2 vaccines that have been approved. We have a third one from Johnson & Johnson, which I think will be approved fairly shortly. And I think we should be well on our way to vaccinations to allow the economy to open up. Then the second reason that we are very optimistic is that the Biden administration has proposed fiscal support policies that we believe will bridge the gap between now and when the vaccinations are done, and also provide additional boost to the economy. You might have already heard about the $2 trillion package that's being debated in Congress. We expect another infrastructure package to come along later in the year. Now, not all elements of the packages may be approved, but I do think that whatever is approved will help the economy in this year and next year. And finally, the third reason that we are very optimistic is that the Federal Reserve has very accommodative monetary policies. The short-term interest rates are hovering close to zero. They continue to buy treasuries and mortgage securities on their balance sheets. And they have made it quite clear that they don't expect to raise interest rates until inflation is well above their target, which is 2%. Next, we will describe to you how we are positioning our portfolios so that it is in alignment with our views and take advantage of what we believe is going to be a strong economy. Now, our views obviously have risks, and we will explain those risks to you finally. And should any of those risks come to bear, we will be dynamic in changing our portfolios as those risks appear. And in the next webinar, we'll clearly point those out as we update our outlook. With that, let me turn to 2020 and briefly go over what happened. If you look at the major indices from 2020, we see on the left-hand side, US stocks, particularly the small caps in the green bar, were up 20%. Now, nobody in March or April would have thought that this was going to be the result, which is one of the reasons why we ask our clients to not time the markets, because the markets over the long run, even though they deliver somewhere in that 8 to 10% returns, in the short term, they can be extremely unpredictable. On the other side, you see that oil prices, the red bar down, were down over 50%. And that makes sense because the part of the economy that was hurt most by the pandemic was really the travel economy. Nobody was traveling on vacations or going anywhere for jobs. We weren't going to work, we were working from home. So everything that needs gasoline was essentially, shut down or fairly drawn down in terms of usage. And so oil prices collapsed as a result. We've seen oil prices now recover in the fourth quarter, and we expect them to continue to recover next year. But it's an indication of how the market distinguished between the parts of the economy that were doing well, such as stocks, versus those that were not, such as oil prices. Similarly, if you look at the third bar from the right, the real estate market also suffered because of the pandemic. One, because we weren't going to shopping malls, and malls are part of the real estate economy. We were not going to offices, and office rents collapsed, and many individuals were laid off, and so apartment real estate also suffered. Briefly, around the world, markets were quite strong. The Chinese market on the right-hand side, you'll see, was up almost 30%, and that was the strongest market in the world, at least amongst the larger major markets. And that's because the Chinese, even though the virus actually originated in Wuhan, China, the Chinese really did an extremely good job of ring-fencing Wuhan and making sure that the virus did not transmit out of Wuhan. And they could do that as China is a very command and control economy. They fairly significantly ring-fenced Wuhan, and so the stock market rewarded them with a very strong return. On the other hand, Russia, which is leveraged to oil, did not do well, and the United Kingdom, which was going through a Brexit with the EU, was also down. The US was up about 20%. If you look within the sector, it's also will become apparent that the stock market was very discerning in rewarding those areas that did well during the pandemic. Technology was up 44%, and that's because technology did not suffer as much in the pandemic. We were working from home, we were shopping on Amazon, we were on Google and Facebook, and we were essentially being able to function using Zoom, and which we are doing right now, and work with each other. On the other hand, energy stocks, which makes sense, were down 34% because of the collapse in oil prices. So the market overall was up 20%, but it was very discerning in which sectors did well and which did not. Bond market was also extremely strong last year. The overall bond market on the left-hand side, you'll see, was about 7.5%. And that's because the Federal Reserve cut interest rates very quickly as they saw the virus spread to support the economy. And as the Federal Reserve cut interest rates, Treasury market, the Treasury bonds, do best when interest rates are down. And you can see Treasuries were up 8% for 2020. Later on, as the economy began to open up, corporate bonds started to recover, also because of a lot of Federal Reserve policies that were supportive of corporate bonds. So corporate bonds, high yield bonds, and emerging market debt that are more leveraged economy started to do better in the second half of the year. And we believe in the bond market, these sectors should do better in 2021 as the economy continues to grow stronger. With that, that was the review for 2020. Let me just give you very briefly our views on 2021. We expect a very strong rebound in the US economy, like I said, because of the vaccine rollout, support from the Biden administration, and the supportive monetary policies from the Federal Reserve. In addition to a strong US economy, we expect that interest rates, particularly on the longer end of the curve, that is 10 years and longer, should head higher as the economy grows and inflation expectations start to move higher. With this in mind, with a strong economy and higher interest rates, we are very positive on risk assets. And when I say risk assets, I mean equities, stocks, and commodities. That's the general framework of our outlook. Now I'll pass it on to Deepak to talk specifics about the vaccine rollout, the Biden administration plan, and finally to Josh to talk about the monetary policy and the Federal Reserve support. Deepak?
Yeah, thank you, Sunil. As you will see in the next slide, vaccines have arguably been the most positive pandemic-related development, really a triumph for science and medicine, if you will. And so far, 2 vaccines based on messenger RNA, which is a new biotechnology platform, from 2 American biopharma firms, Pfizer and Moderna, have been approved. And both of these vaccines require 2 shots per individual. And these vaccines have demonstrated extremely high efficacy of about 95%, which compares with vaccines for diseases like smallpox and polio, which have been largely eradicated. And then, as Sunil alluded, 2 additional vaccines from Johnson & Johnson and AstraZeneca could be approved soon. If approved, the Johnson & Johnson vaccine in particular could prove to be extremely important in helping significantly ramp up the supply because only a single shot would be required. There are no low temperature storage requirements, unlike the 2 mRNA vaccines that are approved, and because of massive manufacturing prowess that Johnson & Johnson has. And then there are other vaccines in various phases of clinical trial here in the US, as well as in China and elsewhere, but the Johnson & Johnson one is the key to come out. And then, so in the next slide, with vaccines being approved, the work of getting these vaccines into the arms of people has been underway. Given the lack of what we call maybe not a cohesive national strategy, the rollout has been uneven at best, with some states executing better than the others. So this is an aggregation of rollout plans for most states. Some states will differ in details. In the first phase, expected to last until about February, most states have targeted to vaccinate healthcare workers, residents of long-term care facilities, EMTs, and first responders. And then in the second phase, which is expected to last from February to April, individuals with comorbidities, other essential workers, and older adults are expected to be vaccinated, adults above 65 years and older. And then in April, if this goes according to the new plan, vaccines are expected to be opened up for the rest of the population. So, as you'll see in the next slide, the biggest question revolves around when does the US achieve herd immunity and the society as well as the economy fully opened up? Some of the projections here depends on the percentage of the population acquiring immunity from vaccination, which is the blue shaded area, which is obviously dependent on effectiveness of the Biden administration and the state's vaccine rollout strategy, available vaccine supplies, percent of the population willing to get vaccinated, although that has been ticking up recently. Now, according to polling, about 2/3 of the US population is willing to get vaccinated. And then the percent of the population which has already had immunity because they have had the COVID-19 infection, which is the purple shaded area. So when you combine all of those factors, the optimistic timeline here is about 70% of the population acquiring immunity, and that's the lowest level experts estimate for herd immunity for the population by about July of 2021. A more realistic timeline, according to some other experts, like including Dr. Anthony Fauci, is for late summer or early fall, where the economy would be fully opened up, hopefully after herd immunity. And so switching gears to fiscal policies in the next slide, The new Biden administration has released its $1.9 trillion COVID relief plan. The price tag has already prompted opposition. So depending on bipartisan compromise or lack thereof, some of these proposals might be excluded from the final version or they might be modified. Major components, as you can see here, of the plan includes a $2,000 stimulus check for qualified individuals and families, funding for vaccine distribution and testing, funding for cash-strapped states and local governments, a $15 minimum wage, unemployment insurance extension, billions of dollars in school reopening, rental assistance, low interest loans for small businesses, etc. So if approved, this plan obviously would provide significant fiscal stimulus to the economy. In addition to this relief plan, the Biden administration is also planning on introducing a multi-trillion-dollar economic plan focused on what they call building a sustainable infrastructure and clean energy. The proposals call for net zero emissions by 2050 and a green electric power grid where we would all get our energy at home through renewable energy by 2035 with batteries backing up solar plants, wind farms, carbon-free sources, etc. The plan also includes EV electric vehicle technology with batteries built here in the US rather than imported from China, funding for other new chemistries, a large-scale energy storage technology, with the goal of cutting costs for lithium-ion batteries by 90%. It's a very aggressive goal. And then there are other investments, including energy-efficient buildings, advancing sustainable agriculture, conservation technologies, etc. If approved and implemented, that's a big if, the plan could fundamentally transform major parts of our industrial, energy, and technological ecosystem. So obviously, some of this excitement, as you'll see in the next slide, macro data is already starting to reflect some of the rebound in the global economy that Sunil alluded to, expectations of the fiscal stimulus that I just discussed, and some of the infrastructure plans. As you see here, the ISM Manufacturing Index, which is the purple line, and the Service Index, which is the orange line, these are indicators of economic activity at major manufacturing and industrial services firms. They're not only in expansion territory, they're just rapidly inflecting upwards. So what are some of the impacts of these potential fiscal stimulus to various sectors? In industrials, for example, machineries that are needed for infrastructure building, think Caterpillar, Deere, etc., companies involved in agriculture technologies, manufacturers of HVAC systems to retrofit commercial and residential buildings should be some of the beneficiaries. In the materials sector, a greener policy tilt in the U.S. could drive demand for a variety of basic commodities. Copper, lithium, and other metals are really, really key to electric vehicle production, for example, and for greener renewable electricity generation. Price of copper, for example, is already up about 70% from the pandemic lows in March. And then in utilities, renewable energy sources were already expected to grow from about 10% of the U.S. current energy mix to about 40%. Now, if this infrastructure plan is adopted, that should further accelerate that trend. So utilities with large exposures to renewables should continue to experience massive tailwinds. And finally, in energy, well, oil and gas should benefit from the economy reopening, as Sunil alluded to, from travel reopening, etc. Fossil fuel, oil and gas continues to be in a long-term secular decline, and the increased investment and focus on renewable energy should only accelerate that decline. Renewable energy costs, for example, have declined sharply over the past decade, and this additional funding by government policy and technological improvements should just be a massive boon to renewable energy in the coming decades. So we've been gradually shifting portfolios to reflect some of these secular and cyclical trends, and as Sunil said, we'll be dynamic to continue to look at what additional risks come out, some of these policies, whether they're implemented or not, and we'll adjust accordingly. With that, I will turn the presentation over to our fixed income portfolio manager, Josh Victor.
Thank you, Deepak. Next, we're going to go through half a dozen slides regarding the Federal Reserve, monetary policy, and interest rates. So on the next slide, we're going to look at the Federal Reserve dot plot. This chart represents the Fed's dot plot, And the chart is a record of each Fed official's forecast for the central bank's key short-term interest rate. Currently, as we can see from the chart, it is set at a target range between 0 and 0.25%. Each of those blue dots on this chart represents one official's vote for where they think the Fed funds rate will be. The dot plot of each committee's members' rate expectation, as we can see in this chart, shows little dissent about keeping rates anchored near 0 through 2023. The committee's 17 members unanimously saw their near 0 stance holding through 2021, and only one voting member expects that to rise in 2022. This can be read as a signal the Fed will remain accommodative. Of note is that the Fed has recently made a significant change to its policy framework in regards to inflation. It will maintain their target interest rate at 0 lower bound until the labor market conditions reach levels consistent with the committee's assessment of maximum employment and inflation rises to and exceeds, I think the key word here is exceeds 2% for some time. That is a new framework for the Fed that will allow inflation to run hot before they consider increasing the Fed funds rate. In the next slide, we'll see another example of the Fed being accommodative with the Federal Reserve balance sheet. The Fed has leveraged its balance sheet to support market liquidity and the economy by buying financial assets. The size of the balance sheet has increased to over $7 trillion. Combined, the G4 central banks, including the Fed, the European Central Bank, the Bank of Japan, and Bank of England, have added an amazing $5.6 trillion to their collective balance sheets in the last 12 months. In December, the FOMC stated that they would continue to buy bonds on a monthly basis, primarily mortgages and treasuries, at the rate of at least $120 billion. And their objective there is to continue to reduce unemployment and increase inflation. The central bank has maintained that they will take whatever steps are needed to sustain the recovery. With the global economy operating below potential at this time, inflation pressures still somewhat muted, central banks are likely on hold for the foreseeable future and are unlikely to end quantitative easing anytime soon. In the next chart, we see the Treasury yield curve. This is the current yield curve 1 quarter ago and 1 year ago. The U.S. Treasury yield curve is a visual representation of interest rates of different maturities of U.S. Treasury bonds. As we can see in the current yield curve, which is the middle one in the dark blue, it is upwardly sloping and can be described as normal, with shorter rates and maturities having lower yields than longer maturities, which have higher yields. A normalized curve with this shape is an indicator of the expectation of a growing economy, rising inflation, and higher rates in the future. We can also see that over the last quarter, intermediate term and longer yields have moved higher, comparing the 1 quarter ago at the bottom to again, the current in the middle. So the longer and intermediate terms have moved higher, while yields shorter maturities have not moved at all. It is likely any changes to the shape of the yield curve will continue to come from long end movement, with the Fed not anticipating raising short rates for at least a couple of years. In the next page, we can see the yield curve steepness. This is another way to look at the shape of the curve. The difference between short and long rates is known as yield curve spread and is a measure of the steepness of the yield curve, comparing the short rates to the long rates and measuring their difference. This chart shows that recently the yield curve has gotten steeper as longer rates have increased. Higher expectations of economic growth, inflation, and anticipation of higher yields in the future will increase the steepness of the yield curve. The steeper the yield curve, the stronger the economic growth expectations of the market. So at this time, the steepening of the yield curve is projecting moderately higher rates and economic growth in the future. The yield curve should continue to steepen as long rates move moderately higher. In the next slide, we can see mortgage rates. The falling mortgage rates were primarily due to the Fed's $600 billion in net purchases of mortgages. Again, referencing that ballooning reserve balance sheet that we saw in a previous slide, which decreased available supply to other investors. The Fed purchases, coupled with strong demand from investors such as banks, helped absorb the increased supply from additional home purchases and the astounding refinancing activity. The falling yields and spread tightening helped mortgages outperform comparable treasuries in 2020. The Fed purchases of mortgages should continue to provide a tailwind to this sector and allow them to outperform comparable duration U.S. Treasury bonds. This will also allow mortgage rates to stay low and should be supportive of home valuations. In the next slide, we can see U.S. corporate and high yield spreads. Riskier sectors such as investment grade and high yield corporates, which Sunil talked about earlier, had strong returns in the fourth quarter and over the last year. And yields have continued to tighten since the March sell-off. Investor sentiment is improving as vaccines are distributed and the markets are supported by unprecedented central bank stimulus. Confidence in a broad-based economic activity improvement is pushing investors towards riskier asset classes with higher return potential during this economic recovery. In a sign of investor exuberance, triple Cs, which is the red bar at the top, have had their best monthly returns on record. At the same time, investor demand drove high yield bond yields to a record low of 4.1%, which is actually an all-time low. The 20-year average for high yield is about 8%. We believe that credit sectors will continue to outperform and therefore overweight these sectors. And I'll hand it back to Sunil.
Thank you, Josh. Thank you, Deepak. I'm going to now share with you how we are positioning our client portfolios to take advantage of our views. And I will summarize this in this chart. So if you look at the overall asset allocation between stocks, bonds, commodities, and cash, because of our view that the economy should expect a strong boost this year for the reasons that we cited, we expect that stocks should do quite well, and we are overweight stocks in our client portfolios. Commodities are an area that we have generally not had any exposure for the longest time, but now we are adding a commodity exposure as oil prices went down significantly and should come back. But also, as Deepak pointed out, there's a lot of demand for commodities in various industrial activities and the infrastructure project that Biden has proposed. So we expect that commodities to be in a positive cycle, at least for the next couple of years. As far as bonds are concerned, we are underweight bonds primarily because of the reason that Josh cited. Rates are moving higher, and when interest rates move higher, bond prices fall. So we are making sure that we are underweight bonds in our client portfolios. Cash is yielding close to zero, and we think that cash should be at a minimum level. We don't expect the Federal Reserve to raise interest rates for the next couple of years. So the return on cash is zero, and the real return, which is if you look at inflation, which might head up to close to 2%, it's actually negative 2%. So if you're not keeping up with inflation, you're actually falling behind by holding cash and bonds. But within bonds, we believe that there are certain areas that will do better and others not so much. Corporate bonds and high yield bonds tend to be much more leveraged to the economy and have a much stronger correlation to stocks. So when stocks do well, corporate bonds and high yield bonds do well. Emerging market debt is an area that we've been underweight for a while, but I think its time has come. One, because we believe that as the vaccines roll out to the emerging markets, their economies should do well, but also because of the proposals from the Biden administration fiscal policies and the Federal Reserve's easy monetary stance, we expect the dollar to weaken. And a weaker dollar means stronger emerging market currencies, and that is usually very, very positive for emerging market debt and emerging market stocks. On the other hand, interest rates going higher is really bad for US government bonds, either treasuries or mortgages. So we are underweight those sectors. Now, even within equities, it's not all equities are going to do well. We believe that small caps or small companies represented in the Russell 2000 are generally best positioned to do well when the economy comes out of a recession. That's because small companies' earnings get crushed the most and have the most upside when the recession is over. We also believe that value sectors represented by energy and financials should do well because they are the sectors that got crushed due to the pandemic, have a lot of operating leverage going forward. Similarly, emerging markets stocks like emerging markets debt should do well as those economies open up and the dollar weakens going forward. Within the sectors, we also like cyclical sectors. I mentioned financials and energy, but industrials and materials, as Deepak mentioned, do well as the economy does well. Plus, you have potentially the infrastructure plan that should provide additional boost to those sectors. So we will clearly, obviously, monitor to make sure that that plan passes before we do a significant overweight on the sectors, but we are very positive on those areas just because of the opening up of the economy to begin with. And finally, defensive sectors like utilities and staples tend to underperform in an economy that's running hot. And that's because they are much more leveraged. They are much more bond-like. They tend to have higher dividend yields, and they are more defensive in nature. Investors are attracted to those sectors more when we are approaching a recession rather than when the economy is opening up. So that's a general picture of our current asset allocation and where we are overweight and underweight. Now, clearly, there are risks to our outlook, and let me explain what they are. First, with COVID-19 itself, we've seen some logistic delays already. We've seen, you heard Deepak mention those. There could be production delays. And so those delays will simply delay the opening up of the economy and the achievement of herd immunity, which is really what's needed for us to go shopping in the malls, to go eat in restaurants, to go travel, and to go on vacations. And I think those delays will certainly hamper the economy. The other factor that you might have read about are these variant mutation strains that have appeared in South Africa, in the United Kingdom, in Brazil. Now, in general, these strains tend to be strains that transmit faster than the original one, but not as lethal. The real concern here is whether they will prove resistant to the existing vaccines. We think that there might be some reduction in efficacy, but we still think that from what we are hearing from companies, that these vaccines will work on these strains. But that's an area of risk that we will continue to monitor as we move forward. The second area is simply the fact that there is so much stimulus in the economy right now between the fiscal package that was passed in December, between the proposals of the Biden administration and the infrastructure plan, low interest rates, the Fed buying bonds on its portfolio, as Josh explained. And also there is tremendous pent-up demand because people have not gone out shopping, have not gone on vacation. And as the economy opens up, if all that, all what we are saying comes to pass, you could see inflation move up much more rapidly as growth picks up very significantly. And should that happen, the Federal Reserve might be inclined to raise interest rates much quicker than the dot plot that Josh was suggesting. And that is something that we will be monitoring to make sure that we can adjust our portfolios should that happen. And finally, geopolitics is always on our radar screen. We have a new administration. They will have new policies towards Russia, China, Iran, and North Korea. And that also is something that we would monitor should that risk arise. With that, that is the conclusion of our presentation today, and I'll hand it back to Brian for questions.
Sunil, Josh, and Deepak, appreciate your expertise. We do have questions that have started to roll in, but this is a good time and a reminder for the group. If you do have questions, if you go down to the bottom right of your screen, you are able to control your control panel and submit those questions. So Sunil, I'll start the first question with you. I'll do my best to direct these at one of you, and then feel free to add on at the end. So Sunil, what is the outlook for oil stocks with people moving around more after the vaccine? And I'm assuming the Biden administration, clean energy innovation probably plays into this a little bit as well. So what are you seeing for oil stock outlook?
Yeah, so in the short term, we are overweight oil stocks. We went neutral to oil stocks as the economy started to open up, and then we went overweight as Pfizer announced its successful test of its vaccine. And the reason we are overweight is because oil stocks just simply got crushed. Oil is not going anywhere, at least for a few years, despite the Biden plan. And this is a cyclical recovery, and oil prices should recover. And if we get a massive boost to the economy, they should actually exceed where they were before the pandemic, and oil stocks should do well. Longer term, we are a little bit concerned about oil stocks because of all these issues with ESG, with the green energy, Tesla, everything that you've heard about. But that's something more longer term, not something that's of risk in the next couple of years. Deepak, I don't know if you want to add anything to that.
I think, Sunil, you surmised it really well. The only thing I would add is oil stocks got crushed even before the pandemic because there was a huge supply-demand imbalance. There was massive production here in the U.S. in the shale fracking. So it's been in a secular decline, but as Sunil alluded, as the economy opens up, at least for the next year plus, we should see a significant boost. But longer term, there are a lot of secular forces playing against fossil fuel. So longer term, I would be sort of cautious, but in the short term to near term, they should do well.
Gentlemen, I'll direct this next question to Josh. Josh, do you want to give some commentary on the muni bond landscape?
Sure, that's a great question, Brian, and actually pretty pertinent. Typically, municipal bonds get quite expensive in the first month of the year. So historically, if you look at ratios between municipal bonds and treasury bonds, the ratio between their yields is a general sign of the richness and valuation of munis or the cheapness. In January, typically there's a lot of money being put to work in the market, and there's a lack of issuance for munis. And that's true this month as well. We've seen a lot of positive inflows of cash being put to work into municipal investment grade and municipal high yield. So there's been strong demand from retail investors. Institutional investors are sitting on a lot of money that needs to be reinvested, and there's a lack of issuance. So at this point, we believe that valuations on munis are quite rich, and we're looking forward to increased supply, hopefully in February, and that should reduce that richness valuation and allow us to put our clients' money to work at better valuations.
The one thing I would add is, Josh, is from a tax-sensitive investor perspective, that remains a reasonably attractive class, especially in the context of asset allocation. If you are somebody who has a need for fixed income or bonds to manage your risk, and you're tax sensitive, then municipals are always an attractive option. But as Josh said, maybe a little bit later in the year.
Yep.
Gentlemen. Next question, is a Democrat-controlled government good for the market?
Yeah, we see this question a lot. We are agnostic between Democrats and Republicans controlling the government. We've seen the stock market do well in both administrations. The stock market did very well when Reagan was president, when Clinton was president, when Obama was president. So we are agnostic, so we don't really think that that is an issue. In this context right now, given the fact that the Biden administration, along with the Democrat control of House and Senate, we think that there's more opportunity for passage of these programs that will give the economy the boost that it needs in the next couple of years.
Neil, maybe I'll direct this next question towards Deepak. Deepak, we heard you talk about herd immunity sometime potentially in Q3. I think probably almost everybody on this call is looking forward to a day and a time where we can go out to restaurants and we can go to the movie theaters and enjoy some of those social interactions that we've so dearly missed for the last 9 months nearly. When might that be possible?
Yeah, thanks, Brian. That's a great question. I'm sure most of us or all of us want to know. I'm not a public health expert, so all we could do is listen to public health experts and listen to the data. So it's all dependent on the speed with which vaccinations go from a supply perspective, meaning these companies providing supplies, states doing it, and mostly individuals willing to get vaccinated. So we at least need to get to 70%, according to scientists, to get to that lower threshold of herd immunity. After that, it's all about personal preference, your risk profile, etc. But I think once you get to 70%, summer, late fall, it should be pretty realistic to see movies and restaurants open up for majority of the population. I would say almost all of us.
We can't wait, right?
Yep.
Right.
Sunil, this question, we'll start with you, and perhaps Josh might have some additional feedback, but maybe talk a little bit about mortgage rates and the housing market and maybe what you guys think might happen in that area moving forward.
Sure. The housing market is hot. I mean, everybody knows this. I think part of it is that there's just not enough inventory going around. I think as the economy opens up, I think people will be more willing to sell their homes, and they might change jobs and they might change locations. So the inventory levels in housing is very, very low. Over the long term, we are secular bulls of the housing market. There's a lot of new construction, new household formation, and new construction that's required. In the short term, if interest rates go up, as we think they will, housing stocks themselves tend to generally react negatively to interest rates, because if you imagine that is the biggest sort of discretionary item. You're talking about a minimum of $250,000 to $300,000 expense, and interest rates are a big component of the mortgage monthly payment. So I think that in the short term, the housing stocks could be somewhat at risk, but if you're going to hold it over the long 5-10 years, I think that's still a good investment. As far as mortgage rates are concerned, I think it's somewhat sandwiched between rates going up and the Federal Reserve continuing to buy mortgages on their balance sheet. We still think that that right now mortgage rates are at multi-decade lows, and as rates tick higher, there's a possibility that mortgage rates could follow higher too, but not too much given the Fed's policy of buying mortgages on their balance sheets. Josh, maybe you want to add to that?
No, I agree. I have nothing to add. I think you answered it well.
Thanks.
Sunil, any thoughts on kind of along the housing front, foreclosures, evictions as we head to the second part of 2021 and into 2022? Any thoughts or comments there?
I think that we haven't really seen the same kind of housing problem that we saw in 08, 09, and we're not really seeing that. I'm not saying that there aren't any, but I just don't think that most consumers seem to be in decent shape. I don't think we have the kind of layered loans kind of stuff that we had back in 09. So we don't think that that's a humongous problem this time around. There could be some bankruptcies in multifamily homes, apartment buildings where people are having some of them having hard time paying their rents. There could be certainly some issues in malls and offices. But in general, I think the housing market seems to be in a reasonably good place. Josh, I don't know if you want to add to that.
Yeah, I'll just add two things. One is that the credit profiles of these borrowers are quite strong. It isn't similar to the 07, 08, 09 debacle, where we had investors getting loans that shouldn't have had the loan in the first place. So while the defaults may go up, it will pale in comparison to what happened a decade ago. And then two, here at Alerus, we have no exposure to non-government-backed mortgages in your portfolio. So even if there was a surprise event of increase in defaults, our clients simply don't have that credit exposure.
And Brian, if I may add something, this has been a tale of two pandemics, right? So there was data out of the Department of Commerce, I think. Anybody that's making over $65,000, that cohort, the unemployment rate has gone down, meaning there has been 4% more jobs from even before the pandemic. The rest of the population, unfortunately, it's been a 20% plus downtick in unemployment. So to add to what Sunil is saying, you combine with the supply-demand dynamic and mortgage interest rates, and people who make $65,000 and more are reasonably doing well, that's a really good recipe for long-term secular threshold for housing markets.
Thank you, gentlemen. Before, Sunil, I turn it back over to you for any closing comments. The questions into the Q&A have started to slow, so if there's any final questions, please get those in there. Otherwise, we can't thank you guys enough for joining us today. And Sunil, I'll turn it over to you for closing comments.
Thanks, Brian, and thank you all for joining us and for all your questions. If you think of questions afterwards, please contact your advisor and we'll be happy to answer them. And we look forward to doing this again in 3 months. Thank you.
Thank you, everyone.